You're listening to the Decisive podcast, insights and analysis to empower confident decision making. Hi, I'm Kristen Hallam, your usual host for the Decisive. In this episode of the podcast, guest host Paul Smith is joined by senior economists Andrew Harker and Phil Smith to unpack the latest global PMI signals and what they reveal about the world economy. The discussion revisits recent concerns around stockpiling, uncertainty, and inflation following tensions in the Middle East, while exploring how PMI data can help businesses and policymakers track fast-moving shifts in growth, supply chains, and trade. The economists also look at global export conditions, the impact of tariffs, and how AI-related demand is showing up in manufacturing, semiconductor prices, and capital investment trends. This is our final episode of The Decisive before the summer break, but we'll be back in August for Season 7 with more insights and analysis from our experts. And now, our PMI team.
Hello, and a warm welcome to the latest episode of the Decisive podcast. I'm Paul Smith, an economist with S&P Global Market Intelligence, and today I'm here to chair a discussion around the latest trends and developments in our global purchasing managers indices. Now, the last time we were on the Decisive podcast back in May, we discussed some April PMI data and we noted several important developments, largely along the following lines and largely, of course, linked to the recent crisis that began in the Middle East. We found evidence of stockpiling amongst manufacturers and their clients, largely to protect against supply chain disruption and price increases that had emanated from that at the start of that Middle East crisis. And we felt the net impact was that this kind of stockpiling was actually pinning some industrial growth. Now, the opposite kind of effect to that was in the service sector. We felt the Middle East crisis was leading to some kind of hesitancy and uncertainty in terms of kind of client activity and broader kind of economic output, and was affecting the performance of the service sector. And we felt all together that was adding up to what we felt was a kind of noticeable risk of stagflationary environment developing. That is, there was little change overall in economic output, maybe a kind of downside risk to a contraction in economic output, but at the same time, elevated inflation. Now, as I said, of course, underpinning a lot of these trends was the crisis in the Middle East, and in terms of the global economy, the affected blockade of a crucial maritime shipping route that has been the Strait of Hormuz. Now, I thought today it would be great to get an update on some of these themes and some other drivers of current economic trends. And I'm joined by two senior economists from our team to discuss this. So first of all, we've got our regular contributor, Andrew Harker.
Hi there, Paul. Yeah, looking forward to helping you pick up on some of those key themes that you mentioned there in the introduction and seeing how they've developed in the past couple of months since our last episode.
Yep, that's great. And secondly, we also have my namesake, Phil Smith, joining us on the podcast.
Hi, Paul. Yeah, thanks for having me back on. I'd like to begin by looking at some of the latest trends in stockpiling that you mentioned at the onset. At the global level, in June, we saw manufacturers raise their purchasing activity solidly again, at a rate of growth slowing only slightly really from May's recent high. But of course, what we're really interested in with stockpiling is how much of that buying activity actually reflects deliberate stockpiling efforts. We can get a view on that by looking at our panel comment tracker data. So reports of companies raising their buying activity to deliberately increase their safety stocks. We've seen those numbers actually fall in the last couple of months from April's peak. They're still running at around twice the long run average, so we're still seeing quite a degree of stockpiling, but not to the level we were seeing a couple of months before that. And as for stock levels themselves, stocks of purchases, those too have continued to increase, but again, the rate of growth has eased back from May's 45-month high. And obviously, with the delays that we've seen as a result of the conflict, things are taking longer to be delivered, so we expect some lead times on those purchases. But what will be interesting to see in the coming months is at what point that sort of stockpiling efforts go from being a driver of growth to potentially being a drag, where sort of the front loading of an activity means there's some payback in the months to come. So we'll keep an eye out for that in the PMI data. And as for uncertainty, we're seeing a similar trend really. So mentions of uncertainty from our manufacturing and services panelists, those mentions have actually come down in the last couple of months. Still running relatively elevated, so roughly 3 times the long run average in June, but have certainly come down. And that's allowed businesses to be a bit more optimistic about their growth prospects in the year ahead. Nevertheless, confidence is still among the weakest we've seen since the pandemic. In fact, it's only been weaker 3 times since the pandemic. So obviously it was weaker the month before in May. We saw it weaker in April 2025 when we had all the issues and concerns around tariffs, and again lower in October 22 when we're in the middle of that tightening cycle when there's rampant inflation all over the world.
Yeah, just to pick up on you mentioning inflation there, Phil, and that period back in 2022, I think that feeds through to the stagflation theme that Paul mentioned in his introduction. If we look at the latest numbers from the JP Morgan Global Composite PMI, we see that actually rates of inflation eased off a bit in June as oil prices softened during the month. And so if we think that maybe the peak of the recent spike in inflation was around April, May time, then that will turn out to have been much lower than what we saw in 2022. In fact, the index points are probably about 10 points lower than the peak back then. So maybe that's not as bad as people feared at the start of the war in the Middle East. Clearly in a bit of a different phase of the economic cycle than we were back in 2022 when we were still in that sort of post-COVID recovery. What we're seeing now really is modest growth in the global economy, and that's softening inflation. So as I said, maybe not seeing the sort of stagflation environment that people may have feared. But again, as you mentioned, Phil, there's still a fair amount of uncertainty in the economy and uncertainty as to how events in the Middle East are going to play out. We've seen in recent days a lot of new information and new events coming in, and so we will have to wait and see. Again, the July data next month will give us an insight into how things are progressing there.
I think just stepping back, as we tend to do sometimes, I think recent months, haven't they, kind of these changes in stockpiling, the uncertainty, the price dynamics, I think has really reinforced to us again the value of the monthly PMI data and how it can really help shape understanding of current economic trends in such an uncertain environment. And I think I always think about kind of policymakers or businesses that are needing to make kind of choices and decisions in this kind of environment, important kind of investment decisions or maybe projecting demand and sales figures. And I think when you're trying to do that kind of thing, it's important to have some confidence around where the business environment and the economy are at this time, especially when there's turning points in the business cycle or market conditions, as we've seen, are changing rapidly. I think you don't want to be waiting in that situation for slowly released official figures, right? They're inherently backward looking, or they maybe cover a quarter rather than individual months, and therefore tend to provide some rather limited insight on the effects of shocks, especially those that occur late in a quarter, like we saw with the kind of developments in the Middle East, very late February into March, when that kind of really started to escalate. And if you think about if you were using some of that official data, you'd still actually be waiting for information on how economies have been performing throughout this period. If you're just looking at, say, quarterly GDP figures, way of knowing where we're at without them kind of PMI data sets.
Yeah, you've done a great job there, Paul, of highlighting the importance of the PMIs that we all know and love and why people need to pay attention to them. Also, those official numbers and the longer term forecasting of those are very important for people as well, as you mentioned. So is there a way in which these two different types of data can be joined together? I don't know, like a formidable central defensive partnership, some of those we've witnessed during the Football World Cup recently.
A nice reference to current events around the World Cup at the moment. And you're absolutely right. And it is something that we've been thinking about recently with our kind of colleagues in the broader global risk and economics business. And we've actually produced a small case study around this, and I'm hoping Kristen, our producer of these podcasts, could maybe drop a kind of a link into the description for the podcast so people can take a closer look at that. But what ultimately that case study does, it just shows the possibility of combining the PMI signals, the kind of near term with our wider macroeconomic projections to give us that fuller picture of kind of the near-term environment and then through kind of the medium to longer term trends in terms of growth and really that emergence of how things are developing over that longer time horizon. And I think that's vital in making those informed decisions around investment or a guarding maybe against what we've seen emerging supply chain shocks, especially as our forecast from our World Economic Service, which we update monthly as well. And it does, I know that they will incorporate as well that latest information from the PMI data. We're kind of doing the heavy lifting there for people. That covers 68 countries or up to 90% of global GDP. So where we've got PMI data, we've also got that macroeconomic projection as well.
Yeah, thanks. I've managed to have a sneak peek of this case study, Paul. It looks really great. And one thing that stood out to me was the relationship between the Eurozone PMI and Eurozone GDP data that's out there. So the PMI data, I think it was mid Q2, was looking at showing some weakness potentially in the GDP numbers. Is that still the case?
Yeah, it's a good question, Phil. And I think our Eurozone PMI is really a great PMI against kind of tracking against GDP trends and developments. And I think it is pretty legitimate of me to emphasize at the time when we recorded our last podcast, I was highlighting some real risks of potential contraction in zone GDP for the second quarter as a whole, and therefore actual potential of a technical recession in the Eurozone. But I think with all this kind of work, and again, it just highlights the importance here of kind of high frequency data, the news flow is really important in helping us to readjust those forecasts. The last month or two, as we've suggested, there's been a little bit more of stabilization in the PMI data. Again, at the time, linked to an easing of the conflict in the Middle East. And then you combine that with some relatively decent official industrial data, again, something that we've highlighted as a possibility. I think there's been a dissipation of some of those downside risks, to be honest. But as we keep emphasizing, there's still a lot of uncertainty, right? But it feels there's an outcome potentially now. There's a path here of a flat GDP reading, or even some kind of very minor quarterly GDP growth is possible. And therefore the avoidance potentially of that technical recession. I don't think it really changes the underlying picture too much, though, in terms of the Eurozone's performance in the medium term. Look, I'm always going to defer to our colleagues here in the wider business regarding the shape of growth of the rest of the year and beyond. But I think the bottom line is that growth is likely to remain fairly subdued, right? Outside of that Middle East conflict, which is very, of course, largely impossible to predict events and how they would affect. There's plenty of other headwinds that colleagues identified at the start of this year. A stronger currency, the potential continuation of loss of maybe market share to mainland China and other economies, among that kind of long-standing competitiveness problem that is apparent in Europe. And then, of course, we also had the higher tariffs on exports to the US. And I think they all remain in play and will continue to weigh on economic performance.
Yeah, it's interesting you mentioning tariffs there, Paul. I think we spoke about that on the previous episode as well. I think it got a mention. Something that's really been substituted in the news flow a bit recently, but definitely a factor firms are still talking about when they're filling in the PMI surveys. Still getting reports from many companies around the world that their ability to export is affected by those tariff introductions. And actually, I was looking at the JP Morgan Global Manufacturing PMI, and while you see quite solid growth really in terms of manufacturing production and new orders, new export orders still actually falling at a global level in June. This weakness reflects declining exports in some of the largest exporters in the world, such as mainland China, the US, and the Eurozone. So definitely signs there, I think, that global trade conditions are quite subdued at the moment. Probably a range of factors at play here, but the tariff environment is definitely still one of them.
Yeah, it's interesting that we're seeing that subdued picture in the PMI export data, especially when you consider the fact that in some of the official numbers that have come out, now I'm sure as many listeners are aware, some of the official export data have looked pretty punchy of late, actually. We're seeing some really strong growth, particularly out of Asian economies in recent months. And if you look into the detail of these official export reports, it seems there's a pretty consistent picture of exports being driven by semiconductors and other products related to the AI boom, the data center build out that we're seeing. And on that topic, it's worth pointing out that with official data, official export data, they are reported, I should say, in nominal or value terms. And what we're seeing is sharp rises in prices of goods related to AI, semiconductors. They are they're really sharply rising at the moment. And so despite the inflation picture at the sort of broader level being a bit more subdued in the last couple of months, the prices of semiconductors are continuing to accelerate. And we're seeing that in our PMI commodities price and supply report, which shows that price pressures for semiconductors are currently tracking about 15 times the long run trend. So that's another reason potentially why we're seeing such strong official exports data. But we can see the evidence of the sort of surge in AI demand in our manufacturing PMIs. The likes of Japan, Taiwan, and Netherlands were some of the top performers in June for manufacturing output growth. And there's also a consistent story coming out of our global sector data too, which showed the tech equipment sector was the fastest growing in June. That pace of growth still accelerating, supported by solid export growth. So the PMI data definitely are bringing out those signals of strength related to the AI build out.
Yeah, just picking up on that picture of AI development and the story around that, I think we can bring in some information from our business outlook survey as well. The latest figures were released a couple of weeks ago. And actually, the capital expenditure element of that was one of the few positives that came out of that survey. Sentiment among firms around things like business activity, employment, profits was generally weaker than was the case earlier in the year. But CapEx intentions were actually revised higher. And then I think that, again, potentially linked to some planned AI investment and all that's going on there. Although worth pointing out that this was primarily a US story. Elsewhere around the world, investment in CapEx intentions there were quite subdued still, but there was a big increase in the US.
Which I think fits into that general perception, doesn't it, at the moment, of the American economy kind of sucking in lots of capital around the artificial intelligence kind of boom, as you guys have highlighted. And I think on the subject of AI, in terms of our survey capabilities, I think it's worth flagging, isn't it, that we'll be conducting another survey of our panelists later in the year. I think it's the third year that we'll be doing this, and it's been a really interesting kind of area for us to expand into. And I know that, Andrew, you've been very closely involved with that, having alongside our colleague Polly. What it's tended to do is been really insightful in terms of understanding how AI is being adopted. Kind of we're getting a little bit more the depths and kind of areas of how AI is being used and its impact on kind of the labour force, such as roles being made redundant or roles being created. So a really broad kind of areas of AI adoption at the moment and how these trends are developing. So I do think that's something that's worth flagging and something to look forward to later in the year. Hopefully we'll be able to discuss that by our final podcast of the year. I think the results should hopefully be available November, December time. If not, we'll be able to discuss it early next year. So I think for now, I think it's probably worth leaving things there today. So a big thank you to Phil and Andrew for your valuable contributions today. We will naturally be heading off for our summer holidays now, but we will be back, of course, later in the year to provide another update on PMI data on the Decisive podcast.
Thank you for listening to the Decisive podcast from S&P Global. Please subscribe and join us for next week's episode. Until then, stay curious and stay informed.